Clock shows just after 10 o'clock. Time to start another DWD webinar. Today, Carrie is going to talk about internal controls. So I think this is a really good topic to talk about every year. I think oftentimes during an audit, we see that there's written controls in place. They're really good. They look amazing on paper. And sometimes when we test those internal controls and we see what's really happening in practice, those can be different or have changed over the years. So I think this webinar is a really good reminder that internal controls should be looked at and they should be reviewed pretty regularly. For our new viewers, I want to take a moment to introduce our team here. So my name is Tyson Moore, Accounting Supervisor. Joining me today is Senior Accountant Audrey Lemon, Director Phil McKinsey, and our partner Carrie Minnick. Just as a reminder, this webinar is live, it's interactive. So for those of you who have questions during the webinar, we're going to try to answer those the best that we can. If you can use the question and answer feature, you should see that at the bottom of your screen. We're going to answer questions throughout the webinar if possible. Also, Carrie's slides are going to be emailed to everyone who attended today after the presentation's finished. That being said, I'm going to turn it over to Carrie to get us started.
Thanks, Tyson. So today's goal, as Tyson said, we're going to talk about internal controls. So today's goal is really to understand controls, fraud risks within nonprofits, and to be able to implement the proper procedures to prevent and deter fraud within the organization. Obviously, we cannot 100% guarantee fraud's not going to happen, but let's talk about some things that maybe we can implement to deter fraud from occurring. The Association of Certified Fraud Examiners back in 2020 in their report to the nations made this statement that nonprofit organizations can be more susceptible to fraud due to having fewer resources available to help prevent and recover from fraud loss. This sector is particularly vulnerable because of less oversight and lack of certain internal controls. And I think that there are some common vulnerabilities in the nonprofit sector related to controls. Oftentimes, nonprofit personnel are wearing multiple hats. They're doing multiple jobs. And so, or also we have limited personnel, limited resources. So there's not a high priority sometimes put on internal controls. Sometimes the board is obviously a volunteer board, but they may have a lack of knowledge of not only financials, but of the internal controls that should be in place. They're responsible at high level. A disengaged board, the culture surrounding the charitable purpose that, here's our main purpose is to follow our mission, to provide our programming, which is true, but we also have to make sure that controls are in place. And then also small organizations, we don't need to have any internal controls or we can't afford them. And that's simply just not true, because we're going to talk today about some controls that even the very smallest nonprofits can put into place. When we talk about internal control, we're talking about a process that is affected by people, designed to provide reasonable assurance. Again, not 100% absolute assurance, but reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. So obviously, when we have people involved, we need to manage that. It's not necessarily 100% guarantee. There could be some deviations, and that's just how it happens with people involved. The importance of having proper controls in place are many. Obviously, to safeguard assets and resources, we don't want theft of the organization's funds or property, but we also want to detect or deter fraud from occurring. If we have proper controls in place, it's going to improve our reliability of financial reporting, making sure that we're reporting the proper dollar amounts on our financials, reduce the risk of errors or misstatements in financial reporting, help us comply with rules and regulations, just demonstrate good accountability as stewards of our organization's funds, and then also support the organization in achieving its mission. So there's a lot of reasons why we need to make sure we have controls in place. So who is ultimately responsible for making sure that the organization has controls in place? Well, really everybody. The board of directors is ultimately responsible for the organization and what happens. So at the highest level, they are responsible for anything that happens at the organization. Many organizations will have an audit or finance committee as part of the board, so they also play a huge role. Management, your executive director, your CEO, employees, volunteers. So really across the board, everyone is responsible for making sure that controls are implemented and followed. So one of the things that we're going to talk about is communication and how important it is to, when we do implement controls, communicating these controls to all of these different groups to make sure that they know what their responsibility is. When we talk about controls, one of the things that comes up is the COSO framework. And for those of you that have DWD perform an audit, you might be familiar with this because we do ask you to answer a COSO questionnaire. And it's a questionnaire that kind of high level talks about, tone at the top and controls that are in place. So that comes from the Committee of Sponsoring Organizations of the Treadway Commission. So that's an actual group of 5 different organizations, and they developed a framework and guidance to help organizations design and implement internal controls. And it's, a lot of public companies and larger companies apply this COSO framework, but we're going to talk about how smaller organizations, nonprofit organizations can implement this as well. So when we look at the COSO framework, it's divided into 5 key areas: control environment, risk assessment, control activities, information communication, and monitoring. And as you can see, each one of these 5 areas has, 2 to 5 different items underneath. And then across the bottom there's an additional 81 points of focus. So I'm not going to go into this huge, what all of this is, but I wanted to share with you that there is an actual COSO framework out there that talks about controls. It's very detailed, and it falls into these 5 different areas. And so what I want to do now is just take a minute to just high level how your organization can implement the COSO questionnaire across these 5 different areas. The first is the control environment. And this is, like I said, is really about setting the tone at the top, creating a culture where everyone understands the importance of internal controls and compliance. So think of it as creating an environment where everyone knows what is expected and follows the rules. So some examples would be making sure you have a code of conduct and an written ethics policy in place. Also, regularly communicating that to everyone, so everyone is clear of what you can and cannot do within the organization, and then also what happens if you fall out of line and don't follow something. So that's really what that means, high level. The second, risk assessment, is identifying and assessing potential risks that could affect your organization's ability to achieve its goals. Really, it's about what you do, your policies, your procedures, your programming, what could go wrong? What could happen to prevent you from doing something to achieving your goals? So for this, we talk about doing an annual risk assessment to identify potential threats. This does not have to be a huge, massive, long out, professional assessment that's done. It can be a board discussion. Okay, let's talk, once a year, let's talk about risks. What kind of risks impact our organization? For example, if you are a nonprofit that gets a high level of government support from specific grants, okay, what is the risk that those grants go away? If they do go away, do we have additional support from somewhere else that can come in and cover that? If we, one of the risks might be, where our building is located. Maybe the building is going to be sold to a new owner. Is there a risk that they will kick us out? So just, it's all kinds of different things that could occur within your organization, but it's just talking about the things that could go wrong, and then how are we going to address those? Are we going to address them? Is there a plan of attack? Or is it something that can maybe wait? When we do a risk assessment process, like I said, it doesn't have to be a big professional thing. It can just be a discussion. Again, a risk is any adverse event that could prevent you from achieving your mission. So like I said, revenue concentration, getting a high percentage of support from a specific donor or a specific individual or a specific type of funding, compliance if you get government funding, those kinds of things, segregation of duties. Do we have one person doing everything? What about staffing and volunteers? Do we have enough staff? Do we have enough volunteers to provide our program? Security within the building. Maybe your organization is located in maybe a not so nice part of town. Do we have the property security in place? What about restricted funds? If we get a large amount of money that's restricted for a specific purpose, are we going to be able to spend that money on those restricted purposes? And then also our reputation. Looking out, Google your organization online. What are people saying about your organization? I think sometimes organizations already do a risk assessment, but it's a very siloed approach. Maybe like the fundraising department, development department, or the programming does it. But you really want to do this as an organization wide. So it covers and encompasses your whole entire organization and what could go wrong. So again, doesn't have to be a huge drawn out process. Just, once a year at one of your board meetings, just take a few minutes, half hour, sit down, talk about what kind of risks could impact your organization. Next is control activities. So these are the actual processes, policies that you've implemented to address these risks. And we're going to talk about more of these later, like the segregation of duties, the checks and balances that are in place. Again, segregation of duties is a very important thing within nonprofit organizations, especially those smaller nonprofits that have limited staff. And we're going to talk about how you can segregate duties within those smaller staffing. And then also just, controls, which we'll talk about and give some specific examples. Number 4 is information and communication. So we need to make sure that when we're talking about controls and implementing these controls, we need to make sure that everyone involved, all those responsible, the board, the committees, the volunteers, the staff, management, have the information that they need to be able to do their job. So they need to know, as part of this control process, what is their role? What is their responsibility? What are they expected to do? Because if they don't know that, then the control cannot be implemented properly and it won't be a success. So for example here, maintaining clear and up-to-date policies and making sure that those policies are communicated through regular staff meetings, emails, newsletters, training sessions to all of those involved. And then finally, the last piece of that COSO framework is monitoring. It's great to go and say you're going to put all of these controls in place and to start putting them into place, but you need to follow up and regularly monitor those controls and evaluate them to make sure that they're working effectively. So it's not going to do any good if you're putting things in place and controls in place, policies and procedures in place, and no one's following them. So we want to make sure that not only we're putting them into place, communicating them to everyone, but we're also following up and monitoring them to make sure that yes, they are working, or do we need to change something? One way you can do that are through internal audits. You might think, oh, internal audit, we can't do that. We don't have enough time. We don't have enough people to do that. That's like what big companies do. That's not the case. You can just do, select a check. Okay, kind of like what we do when we do walkthroughs through our audit process. Select a payroll item, select a disbursement, select a deposit coming in. Walk through that process with the people involved. Are they doing what they're supposed to be doing? Are the processes being followed that you have implemented? So that's kind of just high level, the 5 areas of the COSO framework I wanted to talk about briefly. So now let's go in and talk about some specific examples that you can implement as a nonprofit, even a very small nonprofit. One thing to keep in mind when we talk about controls is the fraud triangle. So whenever there is an opportunity, pressure, and rationalization in place, so whenever these 3 things are in place, there's a higher risk for fraud to occur. So when we're implementing these controls, we want to reduce the risk for the opportunity for someone to prevent fraud, reduce the opportunity for someone to commit fraud. We want to reduce the rationalization that, hey, it's okay for me to commit this fraud. And then also the pressure. Hey, I am really feeling pressure on the board to meet this current financial requirement that we have to do, or something like that. We want to reduce that Because again, when all three of these items are in place, there's an increased opportunity for fraud to occur. All right, so let's get to the specifics. First, let's talk about bank accounts. So every nonprofit has cash, has bank accounts. So how can we put some controls in place to reduce the risk with fraud related to bank accounts? So the first thing, limited number of accounts. So I'm not saying that you just have to have one bank account, but when you look, because I know many organizations have multiple bank accounts, which is completely fine. But we need to look to see how many bank accounts do we need? How many bank accounts do we have? Obviously, the more bank accounts we have, the more risk there is for someone to unauthorized access to those accounts. Check signers. How many authorized check signers do we have on each one of those accounts? Usually organizations will have more than one, because if you just have one and that person is unavailable, it's kind of difficult to sign checks. So usually you want to have more than one, but how many check signers do we actually need? Do we really need 10? Do 10 people really need to have access to sign checks? Something to think about. Most organizations can access their bank accounts online. There's different types, different levels of access. Sometimes you can just limit it to viewing. You can only see what happened. Sometimes there's where you can actually make transfers, make online transfers. So there's different levels of access that can be obtained. So who has access to our online bank accounts? Does that person need to have access? Should they have access? And then what can they do? Can they just get in to see the balance? Can they actually transfer money? Can they make withdrawals? What can they do when they actually get into the bank account online? Please, 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 if you don't do anything else, please reconcile your bank account monthly and do it in a timely manner. Everything goes through cash. And so if you are not reconciling your bank account, then you, first of all, probably aren't aware of how much cash you actually have to run your organization. You also might be missing something that was maybe paid incorrectly or paid to someone that shouldn't have been. So please make sure that you prepare that reconciliation monthly and do it within a reasonable amount of time after the year end. I know sometimes it takes a bit to get your bank statements, but again, a lot of people can go online. Make sure that it's done timely, so that way if something does come up that needs to be addressed, it's addressed timely. And part of that monthly reconciliation should be the review of the monthly bank rec. So one person needs to prepare the bank reconciliation, and then someone else needs to actually review it and make sure that it looks reasonable. We're all human, we make mistakes. So was the bank reconciliation done properly? Was anything missed? Are there old reconciling items that need to be addressed? When you're reviewing the monthly reconciliations, make sure that you not only look at the actual reconciliation itself, but also the bank statement. I know sometimes bank statements do not provide canceled checks. Sometimes they do. They're very tiny these days. But as a reviewer of the bank reconciliation, and if you do have the opportunity to look at canceled check images, make sure you look at those. Just take a look to see, okay, is that signature the person that's supposed to be signing that check? Was this check made out to someone that we normally make out to, and so forth. One bank account equals one general ledger account. So and this usually is how it is. So if you have one, checking account at bank A, then you have a general ledger account that says, so-and-so bank checking, and then savings, and so forth. Some organizations, though, will have one bank account that is split between multiple general ledger accounts. And the reason that they would do this is to track restricted funds or cash for a specific purpose, which I understand that. But if you have more than one general ledger account that goes to one bank account, it's going to make it a lot more difficult to reconcile that each month because you have more than one general ledger account to reconcile it. There's also an increased opportunity for errors or fraud because you're going to have more accounts to go between. So it's best practices to have one bank account to one general ledger account. Limit access to blanket checks. I think this is pretty much self-explanatory. We don't want checks getting into the wrong hands. Bond employees who handle checks in cash. We want that additional insurance protection there. And then debit cards. Let's talk a little bit about debit cards. I know some organizations do utilize debit cards for purchases. When you have a debit card though, you are giving someone direct access to your bank account. You can also make withdrawals on, get cash back on debit cards. So we really encourage organizations to have a credit card instead of a debit card. A credit card is not directly linked to your bank account. There's also some additional protection with using a credit card versus a debit card. So whenever you can, get a credit card instead of using a debit card. So obviously, this is not all of the controls that can go with bank accounts, but we think these are some pretty reasonable ones that apply to all organizations and can probably be implemented by all sizes of nonprofits. So let's move on to receipts. So this would be money coming in. So when we have money coming in, whether it be contributions, program service fees, other income, the handling of the receipts should be independent of the accounting department. And we'll talk a little bit more about segregation of duties, but this means that really money coming in should be handled by one person, not the person that is recording the money into the general ledger. Because we want to segregate those duties so one person doesn't have control and access over cash over the whole entire process. When you have money coming in, it's best to make a list of those receipts by whoever is opening the mail, whether it be the receptionist or a person in your accounting department. So whoever opens the mail should open the mail, make a list of all of the checks that they received. This should be done by someone not putting the information into the accounting system. Immediate endorsement of all receipts. So, stamp the back of those checks for deposit only. So that way only the organization can deposit it and someone doesn't get a hold of those checks. Make sure you're making deposits timely. And that's kind of going to vary on how many deposits, how many checks you get every week. If you don't get a lot of money received through the mail or personally in person at your organization, maybe you don't need to make deposits as much, but you should at least be making them weekly to make sure that that money is not, in someone's drawer, but is actually being put into the organization's bank account. Send thank you letters to donors. Of course, you want to do this anyways as just good practice, but it's also a control over receipts. Because if a donor makes a contribution to a nonprofit and they don't get a letter back, they may question it. They may say, hey, did you get that donation that I sent to you? And then that just provides an additional control, making sure that, yes, the organization did get that check, or no, we actually didn't get it. And someone pulled it out of the mail and took it and, ran off with it. And then finally, reconcile the donor database with the accounting software. So I know that fund development department doesn't always jive with the accounting department as far as how things are recorded. And that's fine. There are differences. But we really want to make sure that we can reconcile the two, especially if you follow GAAP. You're going to have, present value discounts. You're going to have promises to give over multi-years. Those are going to be recorded differently than by the development department. So it's good to make sure that, monthly you're reconciling the money that came in that's been recorded by the development department to with the accounting software to make sure that you're tracking everything, and also just to make sure that everything's getting recorded properly. So next, moving on to disbursements. So these are payments the organization is making out to others. Using pre-numbered checks. That way you can account for all of the checks that are used. If you have multiple bank accounts, multiple checking accounts, don't use the same check sequence for both of them because then you'll get confused. So make sure you use pre-numbered checks. Use checks for all major payments as opposed to cash or petty cash. It just provides some additional audit trail as to what the payment was made. No pre-signed checks. So we want to make sure that we're not just signing blank checks and then giving it for, the check signer signing the check and giving that blank check to someone else to fill out. That's not good because the person that signed the check doesn't know who it's going to. And basically that blank check is free access to the organization's checking account. So we don't want to do that. We prefer that checks are not made payable to cash. So if you do have like a petty cash fund, or maybe you need some cash for an event, instead of writing it out to cash, write it out to the individual's name that's going to get the cash. And you can put like, reason for petty cash, replenish, or whatever event. But by putting it in that person's name, it's limiting, again, who has access to cashing that check. If you just put a check written to cash, anyone who has that, who gets a hold of that check, can cash that check. So again, it's just limiting access to the organization's funds. Properly voiding checks. So if you do have a check, sometimes we have to void it for some reason. Make sure that it's properly voided, write void across it real big, tear off the signature. Also, you should maintain those voided checks within your documentation. So that way we can prove that that check has been accounted for and that it was voided and not an outstanding check. Make sure you review the invoice or supporting documentation for approval before the payment is made. So if you have a vendor invoice or an employee reimbursement form, whatever the documentation is, every disbursement that is paid by a nonprofit organization should have some kind of supporting document to show who it's being paid, who the amount's being paid to, a date, the dollar amount, and business purpose. Oftentimes it's just an invoice from a vendor. But if for some reason you don't have an invoice from a vendor, you need to either create an internal check request form or an internal reimbursement form. Or I know sometimes we lose receipts for like parking or something like that. So you need to have some kind of lost receipt form, or just even something in writing to document what that was for. Because this not only protects the person that reimbursement's going to, or that's writing the check, but it also protects the organization. So that way, if someone comes in and says, hey, we know that you are making payments for XYZ or to XYZ, and we don't think that the organization's funds should be used for that, by having this supporting documentation that has been approved for payment shows that, yes, this is a reasonable business purpose and it has been approved, so we're good. And kind of along with that, that supporting documentation, again, whether it be an invoice or a reimbursement form or a check request form, make sure you do provide that to your check signer when they're signing the check. When they just look at the check and sign it, it's not really telling them much. Yes, they are making a payment to that vendor for this dollar amount, but it's not really telling them what it's for. And by providing them with the invoice or supporting documentation, they can not only, yes, I'm approving this payment, I'm signing the check, but I'm also saying, yes, this is a reasonable business purpose that the organization should be making. Along with disbursements, we mentioned briefly about debit cards versus credit cards. So let's talk a little bit about credit cards. We already said that, if you need a quick, method of payment or online purchases, credit cards are preferable over debit cards. When you do use credit cards, though, we need to consider how many credit cards are out there. Because does every director need a credit card? Does every program manager need a credit card? Does every employee need a credit card? Who all needs a credit card? Because again, the more credit cards you have out there, the more risk you have, because you have more people access to it and you have more credit available that can be used incorrectly by the wrong person. Also, uses. What can the credit card be used for? Oftentimes it's for quick purchases of supplies online, or meetings with donors or board members. What can and cannot be used for? So putting that into some kind of policy, which is the second recommendation, is establishing credit card policy. So obviously there should be card limits. So what is the organization comfortable with as far as putting a limit on each person's credit card? Again, noting what are the permitted purchases and disallowed purchases. Maybe for some reason, your organization, you don't want to have people purchasing alcohol for any reason. And so that would be a disallowed purchase. So, and that, that's going to vary organization to organization, but making sure that people are aware of what they can and cannot use the credit card for. And then also a policy for charges without receipts. So sometimes when we purchase things, we don't necessarily get a receipt, or we lose a receipt, or sometimes we get, you go to a restaurant and you get two receipts. One is just the credit card receipt that says, yes, the credit card was charged for X dollars, versus the receipt that has the actual description. So if you have somebody, a staff person that uses a credit card and they don't have a receipt, what should they do? Do they need to fill out a form? Is it not going to get paid and they have to pay for it out of their own personal funds? What is the policy for making sure that you have documentation for all of those credit card charges? And when that doesn't happen, what needs to happen instead? Along with that is requiring original receipts to be submitted and do it timely. Just like with a bank reconciliation, you want to make sure you reconcile your credit card monthly. And in order to do so, you really need to have the receipts so you know what was being purchased and if it was a reasonable business expense. So, how timely is it? Within 15 days after the end of the month? Is it within 30 days? How timely do they have to have their receipts submitted for credit card purchases? And then also, like I said, same way how we reconcile bank statements, we want to make sure that we reconcile credit card statements. And so we want to make sure that there's a process in place to do so, that someone is reviewing those charges, making sure it reconciles to the credit card statements. One thing when you're reconciling credit card statements, obviously you want to look at the actual credit card statement itself, but also look to see if there are any advances. So with credit cards, you can do cash advances. There should not be cash advances on a nonprofit organization's credit card statements. That is a red flag. So when you are reconciling the credit cards and having somebody review those, take a look at the credit card statement to make sure that there are no cash advances on that. Moving on to payroll. Obviously, most organizations do have employees, but not all. So those of you that do have employee and pay salaries, make sure that your at least those that work part-time that aren't paid a salary submit timesheets. These timesheets need to be reviewed and approved. And when we talk about reviewing and approving items, we want to make sure that when that is done, it is documented. So whether it be initialing and dating on the face of the timesheet, the face of the bank's reconciliation or the credit card statement, or if you do it electronically. I know we have some clients that have a pretty spiffy way of approving documents electronically, and it says who the email is that approved it. You can do that electronically. You can do it via email. You just need to make sure that it's properly documented what is being approved and who is approving it and when. So again, back to approving and reviewing timesheets. By doing this, this shows that, because we want to make sure that the people that are being paid a salary have actually worked those hours, and they're not, number one, making up bogus hours to get paid more, and number two, that they are actually employees of the organization. You want to also review and approve your payroll register. So whether you process your payroll internally or outsource it to a payroll processing company, make sure that once the payroll is processed and they provide you with that payroll register, that you review it and make sure that it was done properly. Make sure that the individuals that got paid were yes, those are employees. Yes, they should have got paid this pay period. Make sure that the proper payroll taxes are being withheld and paid. If you see an employee that's not having any payroll taxes withheld, that's probably not correct. So you might want to look into that. Any other type of employee withholdings, making sure that those are properly withheld as well. So just kind of give, and more than likely your payroll is probably going to be very similar month or period to period. So it shouldn't take too long, but just kind of give a, look over that to make sure that everything looks good each time. Establish a process for payroll changes, adding or removing employees. Again, this is both for if you do your payroll internally or if you outsource someone. When we need to add an employee, take off an employee, if we need to change their pay rate, what is the process that is in place? Can anybody do it, or is it just one certain person? What kind of documentation needs to be submitted? Because the risk here is that we're going to create a ghost employee. A ghost employee is someone that doesn't actually work for the organization, but is a way to commit fraud, where we set up a person, a ghost, that doesn't work for the organization, and we issue them a paycheck. And then that person who's committing the fraud pockets that money. So probably want to make sure that you have proper documentation that's signed by the new employee. And then also for the change in pay rate, making sure that that pay increase has been approved by someone, proper member of management, board, to ensure that, yes, that person should get that increase in pay. Utilize direct deposit whenever possible. This just cuts down on the risk with paper checks. It's just a lot easier, a lot cleaner to utilize direct deposit. I know not everyone can do that, but I think most people are going towards that. Obviously, you know, the first pay, you have to write a check, but trying to utilize direct deposit whenever possible just limits the risk associated to those payroll checks. And then finally, using a payroll provider. One thing I want to comment about this is, well, first of all, we encourage using a payroll provider because then, you know, usually that payroll processor, they are aware of the payroll rules. They can make sure that the correct amount of payroll taxes are being withheld and paid at the correct rates and so forth. However, a few years ago, there was a big issue in South Bend with a payroll processing firm that wasn't remitting payroll properly, payroll taxes. So again, that's a reason why you just want to make sure that you are reviewing and documenting things that you push over to an outside source. So normally, using an outside third party, an expert with payroll is fine, but you just still have to watch what they're doing to make sure that those payroll taxes are being withheld and paid properly, and that the individuals that should be paid are being paid at the correct rate. All right, moving on. Next is financial reporting. So this is more about, you know, your accounting software, your reports that you're looking at, because we want to make sure that these are correct as well. Detailed chart of accounts. So we want to make sure that when we set up our chart of accounts, that it is reasonable. Do we have the correct chart of accounts set for our organization? Do we have the proper revenue items categorized, the proper expenses? Not only for management to make the best decisions so they can see the financial activity every month, but also when reporting transactions, is it clear? Like, we don't want to have one expense account called general expenses and just throw a bunch of stuff in there. If we do that, there's a higher risk that someone could submit a reimbursement for a personal item or pay somebody that shouldn't be paid, and it just gets shoved into like a general expense. So we want to make sure that we have reasonable revenue expense, just basic general ledger account set up so that we can monitor the organization's activity. Use your budget. So hopefully you all create a budget every year and that you don't just create it and put it on the shelf. A budget is a living document that should be utilized at least monthly, and compare it to your actual financials for the month. By doing so, you'll be able to tell if something is off. Now, variances from budget to actual are expected sometimes, you know, maybe timing of grants, or maybe you didn't get a grant, or maybe you had an unexpected expense. So that's reasonable. But sometimes when there's variances, there's really not a clear answer right away. And that could be a sign of fraudulent activity. I'm not saying that it always is, but it could be. So that's why it's so important to compare your budget, where you think you are, to where you actually are for the month. And this should be done timely as well. Not only comparing it to budget, but comparing it to, the prior month, prior year to date. It just kind of makes sure that you are on the proper track for the year. By doing it timely as well, if something is recorded incorrectly, or if there's some kind of fraudulent activity, you can catch it faster. So make sure that your board, your finance committee, management is able to review those financial statements timely each month. And when I say timely, you should have a process that your financial statements, that the month is closed within a reasonable amount of time after the month ends. So that way you have that information to review and make decisions going forward. If you don't already have a policy and procedures manual related to accounting, financial reporting, make sure you put one in place. If that's something that you don't have and you would like a sample, please let us know. We can provide that to you. But again, that just kind of provides some additional oversight and roles and responsibilities as to who's doing what and how often they're doing it and when they're doing it. Along with that is creating a month-end checklist to make sure that you have addressed everything for the month. So have you reconciled all the bank accounts? Have you reconciled the credit card statements? Have you reported depreciation? Have you recorded any additional receivables, or maybe looked at the allowance to make sure that all of these receivables are collectible? So making sure that you have that checklist in place encourages you to review certain things every month to make sure that your financial statements are accurately presented. Journal entries are one way that financial statements can be misstated, whether it's to fraud, human error, or just negligence. It's reasonable that nonprofits have to make journal entries to make corrections, to record non-cash items. Journal entries are common. They should be made when needed. However, we need to make sure that somebody is reviewing those journal entries, again, in a timely manner, to make sure that those journal entries are correct. People reverse debits and credits. We put the decimal in the wrong place. We fat finger numbers. So sometimes it's just human error. Sometimes, though, it could be trying to manipulate balances by moving things around. So it's very important to make sure that the proper member of management is reviewing journal entries. This should be someone, not the person that actually entered the journal entries, but someone else approving them. Even if you have your board treasurer do this, or maybe someone, if you're a very small organization and don't have a lot of accounting staff, you still need someone to review these journal entries. If they are not, a financial expert themselves, but they will see, once they start reviewing the journal entries month after month, they will see what type of journal entries are made, and they'll be reoccurring journal entries. And then when they see something out of the ordinary, they can question that. So just having that additional oversight is really important for nonprofit organizations. Next is technology. So we all know the high risk associated with technology, and we all rely so heavily on technology in everything that we do. Restricting access. Now, this is whether it's your accounting software, whether it's QuickBooks or Intact, or whether it's your fundraising software, or maybe you have some kind of, you work with clients and you have a client software. So making sure that the correct people have access, and the people that don't need to have access don't have access to that. Make sure that each individual has their own password and login. We don't want to share passwords and logins, because if we share them, then we don't know if something happens. We don't actually know who the person was that made that entry or recorded that transaction. Again, don't share passwords. Backing up data off-site. I know a lot of software now is in the cloud, so we really don't have to worry about that, because that kind of does its own backup, but just making sure that you do, if something were to go wrong, if your computers were to crash, that you do still have access to your information. Use antivirus software, spam filters, firewalls to protect the systems. I know this is a really huge thing right now as far as the bad people trying to access stuff via software. So making sure that all of that's in place. Implement policies on computer usage. who can use the computers, the organization's computers. Can they take the laptops home with them? Can they do personal work on a laptop? Can they only access can they only access the organization's software or like QuickBooks Online through an organization's computer? Can they do it at home on their home personal computer? Do they have to be in the office? So stuff like that. Again, limiting who has access to what. Training staff, just making sure they're aware that they stay vigilant with this type of items. And then reviewing system access logs for suspicious activities. Again, that's why it's so important to have unique usernames and passwords so that when things do happen, we can tell who is in the software at the time and then address that appropriately. So those are kind of some specific controls that we think any nonprofit can put into place in specific areas. Now, next, I'd like to talk specifically about segregation of duties. So the importance with segregation of duties is making sure that we are dividing these three key areas. Authorizing transactions, so approving payments, approving things, recording transactions, so actually putting them into your fundraising software, your accounting software, and then maintaining custody of the assets. So like actually opening up those bank statements or getting the cash in the mail, the checks in the mail. So those are the three areas we want to try and segregate as much as possible. So we know that a lot of nonprofits don't have a staff of 12 or 20 or 50 in their accounting department to segregate duties as much as they can. So here are some examples on how you can do it with 4 people, 3 people, and 2 people. So and again, these slides will be provided to you afterwards, so you can, we'll send all these to you. So these are just some examples. So like the first one here shows how you can segregate duties between 4 different people. Now it does say accounting staff, accountant, and accountant. It does not have to be an accountant. It could be your board treasurer. It could be your receptionist. It could be a program person. The key is that you have 4 different people doing these items. And you can see the different tasks that have been assigned to each one of these areas. So like signing important contracts, making compensation adjustments, signing checks. And we have someone writing the checks. We have someone mailing the checks. So you can see some examples here on, hopefully this is useful on how you can segregate duties with 4 people. Now, if you don't have 4 people, and maybe you have 3 people. So here's an example of how to segregate duties with 3 people. Again, it refers to accounting staff and accountant. Other does not have to be an accounting staff. Could be board members, could be receptionists. Again, the key is having 3 different people allocate these responsibilities between themselves. And then finally, 2 people. So hopefully you don't just have 2 people, but if you do, here are some ways to allocate duties between 2 individuals. Again, it says accountant, doesn't have to be an accountant. What's interesting though is that, in the state of Indiana, the law says that every nonprofit has to have at least 3 people on their board of directors. So every nonprofit should have at least 3 people to segregate duties for. If they are all volunteer, have no employees, no executive director, and just have a board, they should have at least 3 people that they can segregate duties between. So, and again, we're not saying that we understand that there are limited resources and that you can't go hire a lot of different people to just add to your accounting department, but try to segregate duties as much as possible with the people that you do have. If you do have people that maybe don't have an accounting background and you think, oh no, they can't do this because they don't understand accounting, that's okay. You can either train them or, like I said, with the journal entries, once they start doing it, once they start seeing the same thing month after month, they will question, if they see something out of the ordinary. Also, just the idea that someone is looking at it kind of reduces the risk for fraud to occur. So there's, the story I hear at several trainings that I've been to where, the CEO gets the bank statement and he gets it from the mail. He goes into his office and he just throws it on his desk. He doesn't even look at it. But the accountants think that he is. Now, obviously, he should look at it, but just that showing that he takes it, goes into his office, that they think someone is looking at it. Now, again, they should, but that kind of limits the opportunity there for someone to try and commit fraud. So big thing with controls is segregating duties as much as you can. So we talked about the COSO framework, giving you some specific examples on controls in the different areas, and then talked about segregation of duties. But again, this is really not going to be effective unless you communicate this with all of those involved. So your board, your committees, your volunteers, management, employees, they need to know what these policies are that are in place, what their responsibility is, and just making sure that the tone at the top is good, that we don't, that we want to make sure that these controls are being followed. If you want your employees to submit employee reimbursements with receipts, with the proper receipts, your executive director or your CEO needs to set an example and do that. So not only is it important to put the controls in place and communicate them, but your culture, setting that ethics, that code of conduct to make sure that, yes, this is the type of organization we are. We want to make sure that we have controls and that we follow those controls. And that's, that's kind of organization that we are. So that's all we have on controls. I just wanted to share one more thing. We do have various resources specific to nonprofits on our website. It's all completely free. Various blogs about specific topics we think that nonprofit organizations would be interested in. You can also sign up for future webinars. We also have previously recorded webinars on our website as well. So we'll just want to make sure that you are all aware that that is available to you. If there's anything that we talked about today, specific policies, whether it be a financial policy, credit card policy, those types of things that you don't currently have in place that you would like to put in place, please reach out to us. We do have lots of samples that we would be happy to provide, so that way you don't have to reinvent the wheel. And with that, I just want to thank you again for attending and hope you have a good week. Thank you.